Some of the most common questions I get over on our Patreon has to do with how dividends are taxed. Given how vast this topic is, I decided to put together a guide that'll hopefully help investors who have questions about how dividends are taxed and what to expect from various different types of dividend-paying investments. Before we get started, I have to make a few disclaimers. The information in this video applies to investors in the United States. So obviously, things can differ pretty significantly if you're outside the US, and you'll need to check with your own local laws and regulations to determine how much of this information applies to you if you're outside the US. This video is for informational purposes only, and if you have any really complex tax questions, you'll want to speak to a tax expert regarding the issue. Because this video is serving as a general guide, I'm not going to go too in-depth on advanced tax strategies, and also note that laws and tax brackets change, so depending on when you happen to watch this video, some of this information may be outdated. So that's something that you're going to want to check. But with that being said, let's go ahead and get started. For starters, here in the US, there's a lot of different types of investment accounts. First, you've got your standard brokerage account, otherwise known as a non-retirement account, and within this type you have different variations, with the two most popular being individual accounts and joint accounts. Individual accounts are just for one person, which is the most common, but you can also open a joint account, which can be used by a married couple or even a parent or a child over the age of 18. When you invest in dividend stocks in these accounts, you're responsible for paying taxes on the dividends in the year that you receive them. That's regardless of whether you choose to reinvest your dividends, otherwise known as dripping, or if you receive the dividends in cash. You'll still have to pay taxes on the distributions in the year that you receive them. The second type of investment account is a retirement account, and there's a handful out there that exist. You've got traditional IRAs, Roth IRAs, 401ks, SEP IRAs, and so on. What's great about these accounts is that the IRS taxes them differently from non-retirement accounts, which will save you money when you reach retirement age. The two most popular retirement accounts used for dividend investing are traditional IRAs and Roth IRAs, which is what I'll be focusing on. These are as easy to open as a non-retirement account, whereas 401ks and SEP IRAs are offered by an employer if your job happens to have them as a benefit. With both traditional and Roth IRAs, you aren't allowed to withdraw money from them before turning 59.5 years old without being subjected to a 10% early withdrawal penalty. Traditional IRAs and Roth IRAs do differ in terms of how you're taxed, so I'll give an overview of the differences that exist. Traditional IRAs allow you to make tax-deductible contributions, which means you won't have to pay income taxes on the contributions that you'll make in the year you contribute. You basically choose to receive a tax break now as opposed to later in life. The money or the dividends you withdraw later in retirement will be subject to income tax when you take the money out of a traditional IRA. For practically everyone though, when you do reach retirement age, you'll be in a lower tax bracket compared to when you're working full-time. So since you'll be in a lower tax bracket, you will be paying fewer taxes later on. When you receive dividends from your holdings inside of a traditional IRA, you don't pay taxes on them in the year that you receive them. Instead, you'll only pay taxes on them in the year that you decide to withdraw them from your account. With Roth IRAs, you make contributions using the money that you've already been taxed for, otherwise known as after-tax contributions. But what's nice about Roth IRAs is that the investments grow tax-free, and when you make withdrawals during retirement, then you won't have to pay any taxes on them. So at no point in your life, unless you're under 59.5, will you ever have to pay taxes on your dividends in a Roth IRA. It's for this reason that I prefer Roths over traditional IRAs, although both of them are good options that'll save you money on taxes. One of the most common questions I get is whether a retirement account or a non-retirement account is best when it comes to dividend investing, and although I suggest opening both non-retirement and retirement accounts, it really does come down to your own personal goals and preferences. Because with IRAs you can't withdraw money from them until you're 59.5, if you dream of living off dividends before this age, like if you're pursuing the financial independence retire early strategy, then you'll want to focus more on individual accounts. If you think it's unlikely you'll be able to live off dividends or your investments before 59.5, or you simply just don't want to retire from your job early, then focusing on an IRA is going to be the way to go for you. If you're also the kind of person who hates paying taxes more than anything else on earth, then going with an IRA is also going to be your best strategy. Keep in mind though that you can only contribute $6,500 a year to an IRA, so if you really do want to pursue living off dividends and you happen to be much older, then it's going to be harder for you to achieve this in an IRA, and you'll probably want to pursue dividend investing in both non-retirement and retirement accounts. When it comes to how dividends are taxed, there's two main categories for them, which is qualified dividends and ordinary income. With qualified dividends, there's two requirements that must be met for an investment to classify their distributions as being qualified. They must either be a corporation located in the US or a foreign corporation that's publicly listed on a US stock exchange that isn't a pass-through entity, and you also must own the stock for at least 60 days within a specific 121-day holding period. The 121-day period starts 60 days before the ex-dividend date of the stock, which is 60 days before the next dividend is paid out. Qualified dividends are taxed at a lower rate than ordinary income. But remember, if you're investing inside a retirement account, then there is no such thing as a qualified dividend. In a trad IRA, your dividends are taxed at your current income tax bracket, and nothing that comes out of a Roth IRA is ever taxed. Dividends that are classified as ordinary income are the result of several different circumstances. That would include dividends paid by money market holdings, certain foreign entities, employee stock option dividends, one-time dividend payments made by certain investments, as well as pass-through entities. Some examples of pass-through entities would include real estate investment trusts and business development companies. As the name suggests, ordinary income dividends are taxed at your current income tax bracket. Here are the current tax brackets side by side with each other. You can see that dividends that are qualified dividends do get taxed at a lower rate than ordinary income. The downside is that most stocks that offer qualified dividends have very low yields, anywhere from less than 1% to about 3% on average. If you're curious about the tax treatment of an investment's dividends, there's a few ways that you can check. If you're looking at an exchange-traded fund, then you can go to ETF.com and type the ticker symbol at the top of the page. If you scroll down on the page, it'll tell you if a fund's dividends are qualified dividends or if they're considered ordinary income. Note that because ETFs hold a basket of different stocks, it's possible that an ETF's dividends could be partially taxed as qualified dividends and partially taxed as ordinary income. You won't know for certain what the percentage is until you receive your 1099 DIV form at the end of the year, but some companies do post past previous year's 1099s on their website, so you can kind of get an idea as to what to expect. For individual stocks, some websites do tell you whether a stock usually pays qualified or ordinary income dividends. One website is Dividend.com, where you can type in a stock's ticker symbol at the top and then scroll down to the dividend payout history. You can see if the dividends it typically pays out are classified as either qualified or non-qualified by the IRS. In this example, Clorox stock's dividends are always qualified, so they will be taxed at a lower rate if held in a non-retirement account. When it comes to certain types of funds, such as closed-end funds, there are some further classifications that dividends fall into. With closed-end funds, for example, dividends can be classified as income distributions, otherwise known as interest distributions, short-term capital gains, long-term capital gains, and return of capital. As you might have guessed, long-term capital gains are subject to long-term capital gains tax, and short-term capital gains are subject to short-term capital gains tax. Dividends classified as short-term gains are taxed at a higher rate than long-term gains, and it basically means that some of the assets inside the fund were sold and the proceeds were used to pay dividends. Stocks in the fund that were held for at least 1 year before being sold are long-term gains, and stocks that were held in the fund for less than 1 year are sold as short-term gains. Long-term capital gains are going to be taxed at a lower tax rate than short-term gains, which are going to be taxed at your current income bracket. With interest income, these dividends aren't eligible for any special tax treatment and they're taxed as ordinary income. Then finally, there's return of capital. These dividends are a portion of your original investment amount that are paid back to you by the fund. When you receive ROC dividends, these are not taxed because you're basically getting back some of your investment from the fund. While not having to pay taxes for these dividends might sound great, a fund that regularly pays out return of capital is not a good sign. This indicates the fund is unable to earn enough income from their investments inside the fund to pay their regular dividend distributions. It's a sign that a dividend cut is possible because the fund is basically paying back some of its assets to its investors, which in turn is shrinking the fund's portfolio. The same goes for capital gain distributions, which indicate a fund has to sell some of its holdings to pay its investors. Funds that regularly pay large amounts of these types of dividends should be avoided or heavily monitored by investors. Ideally, most if not all the dividends that a closed-end fund pays should be classified as interest income. But if you see capital gains or return of capital every now and then it's not always a bad sign. If you're wondering how a fund's dividends are classified, the best way to check this is by going to the fund's website and looking at their dividend distribution history. Some websites will have it under their tax section, and some will have it under news in the investor relations section. You can also go to cefconnect.com and look up a fund by its ticker symbol. Click on distributions and scroll down to the bottom of the page. You can see if a fund's dividends have historically been interest income, short-term capital gains, long-term capital gains, or return of capital. When the tax year ends, you'll need to report the dividends you received in your non-retirement accounts when you file your income taxes. According to the IRS, if you receive at least $10 in dividends, you are required to report them. The tax form you can expect to receive for most dividend-paying stocks is IRS Form 1099-DIV. Every dividend-paying stock that you held in the tax year will send you one of these forms, but fortunately every major brokerage platform will send you a consolidated 1099-DIV form. This basically combines every dividend you received from every dividend holding in the prior year and basically sums it up for you so you don't have to add up everything yourself. That way you don't get 20 different 1099 forms if you have a lot of dividend stocks. Reporting dividend income is pretty straightforward on your 1040 if you're using software like TurboTax. If you get to the point where you start earning a really sizable amount in dividends, what I'd recommend doing is paying quarterly taxes to the IRS. You can do this on their website and it only takes about 5 minutes to do so. That way you don't have to save a certain percentage and pay it all at the end of the year. It's a 1040 ES transaction and it definitely helps lessen the burden at the end of the year. When it comes to investing in dividend stocks located in other countries, there's a few additional considerations you need to keep in mind. Depending on the country the stock is located, if you're serious about investing in international dividend stocks, I'd highly recommend either talking to a tax professional or looking up that country's laws first because there can be different rules with how foreign stocks are treated. Some countries like Israel will automatically take out a percentage of your dividends before you receive them. So for example, if you calculate and determine that you'll receive $25 per quarter from a foreign dividend-paying stock, and that country takes out 25% of that for taxes, that $25 dividend will really be more like $18.75 when you receive it. If you own a dividend stock from a country that has a tax treaty with the US, then you can reclaim the difference. In this example, because Israel has a tax treaty with the US, you can claim foreign tax credit on your income taxes. But with many foreign companies, the way they get on American exchanges is by issuing ADRs, or American Depository Receipts. These are certificates issued by a US depository bank representing a specified number of shares of a foreign company's stock. When you invest in an ADR, the share price and dividends are automatically calculated into US dollars. The downside, though, is that there are fees associated with owning an ADR stock, and the fee usually comes out of the dividends if it's a dividend-paying company. Here's an example of a Canadian company whose stock trades on the New York Stock Exchange. You can see I received a dividend payout of $17.80 in US dollars, but there was another transaction for withholding which took out $2.67 from that dividend. So really, I only received $15.13 from that distribution. To find out how much a company is going to take out of your dividend distributions can be found by going to their website. They'll have an investor relations section for US investors that'll have this information on their dividends. You can also find out what exchange a stock trades under by going to any financial website or simply going to Google and typing the ticker symbol and then stock after it. If you're wondering, there are some dividend-paying funds that exist that are tax-free at the federal level. Although this is another topic I'd suggest talking to an expert about or doing your research because it can largely depend on where you live and your own local laws. There's a handful of closed-end funds, such as the Naveen Select Tax-Free Income Portfolio, that focuses on providing current income exempt from regular federal income tax. The way these funds typically do this is by investing in municipal securities issued by different states. With these funds, there actually is a way that you can save money on some of your state taxes, which is if the closed-end fund holds a lot of securities from your own state. In the example of the fund we just looked at, 18.3% of its holdings are from the state of California. So if you happen to live in the state of California and own this fund, then you can save a certain percentage on your own state taxes too. It should also be mentioned that there's one type of dividend-paying stock known as a master limited partnership that doesn't actually issue investors a 1099 tax form, but instead something called a Schedule K-1. This is because when you invest in an MLP, the IRS considers you to be a partner of the company as opposed to being a shareholder. Or sometimes they'll refer to you as a unit holder instead. These tax forms are known for being pretty difficult to handle on your own, and I always recommend either using software like TurboTax or going to a tax professional to handle it. I believe if you have TurboTax file your taxes and you give it a K-1, then it will cost more than their most basic software version, but I can't confirm this. You'll want to look into this and plan ahead before investing in an MLP. I know practically all tax professionals will charge you more if you hand them over a K-1 tax form. Most master limited partnerships are either in the oil or energy sectors, although there are some outliers. A couple examples would be Icon Enterprises, ticker symbol IEP, as well as Cedar Fair, ticker FUN. There's a few different ways you can check if a stock is a master limited partnership. All of them will say so on their website, and they will have K-1 information. If the stock has LP or LLC at the end of it, then that's another good sign that it might be an MLP. Some stock websites will also tell you if a stock distributes a K-1. If it's an ETF or some other kind of fund, you can go to ETF.com, enter the ticker symbol, and see if it issues a K-1. Note that most ETFs that invest in MLPs don't issue a K-1, but instead a regular 1099 DIV, which makes things easier if you do want MLP exposure in your portfolio. And that pretty much covers all the knowledge that the average dividend investor will need to know about dividend taxes. If you have any really complex questions, it's always best to seek the expertise of a tax professional who can help you based on your specific situation. Remember, depending on when you watch this video, it's possible that some of this information may be outdated, so do your own research to make sure that everything in this video is still up to date when you happen to be watching. But with that being said, thank you all so much for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.